Hello! In this video, we'll consider the tax consequences of distributions by a partnership to a partner and retirement of the partner. Now, it's important to understand that this discussion takes into account some of the discussion from the sales of a partnership interest. I strongly recommend watching that topic before you consider distributions. Generally speaking, distributions are a lot more difficult than sales of partnership interests, and once you get the idea of a sale of partnership interest, it helps with the understanding of distributions because, again, this is going above and beyond in terms of the steps. So I just want to contrast distribution with respect to sale of a partnership interest. So sale of partnership interest. So a sale of partnership interest means that the partner is selling his or her interest, whether it's all of the interest or a portion of the interest, to outside the partnership or another partner. So a party other than the partnership. A party other than partnership. So by outside meaning other than the partnership. Versus the distribution can take many different flavors. And we're going to talk about those different flavors in just a moment. The idea, though, is that in a distribution, you're dealing specifically just with the partnership. You're dealing just with the partnership. The partner's dealing just with the partnership. And you're going to see that there can be no decrease in ownership and partnership interest. There can be a full decrease or partial. So just with the partnership. Just with the partnership the partner is dealing with. And that's really the key distinction. And make sure you know that because the rules are different. The rules are different. So really here's our analysis. We're going to break up our analysis of distributions because there's special rules. So we have simple and complex distributions. So the best way I always tell anyone that's learning about distributions for the first time is think about distributions here. Let's do a little chart, little tree. From distributions, you can have two types. You can have simple and you can have complex. Now the rules for complex, we're talking about the rules. The rules for complex are all the same. So whether the complex distribution is a liquidating distribution or a non-liquidating distribution does not matter. What's the distinction? Liquidating means the partner no longer has an interest after the event, no longer has ownership. A non-liquidating distribution, also known as an operating distribution, the partner either does not decrease their ownership at all or decreases it just a partial amount. They still have ownership after. So for simple distributions, we have to break them up between operating or non-liquidating, we also call them current sometimes, and liquidating distributions. And you're going to see that there's different rules, and the reason there's different rules, it's going to make sense later on, deals with if you have a liquidating distribution and you're a partner, you no longer have an interest afterwards. So there's no way you can recover your basis later on. So that's really the key there. Now, simple distributions versus complex distributions. What's the distinction between these two and why do we have different rules? Simple distributions do not alter interest in Section 751 property. 751A property. Complex distributions do alter. They do alter the 751 items. We call those hot assets. Hot assets. Now, mixing bowl and other anti-abuse provisions, that's just special rules. We're not going to get into that, but because that's beyond the scope of this presentation. But I just want to mention that. I'll show you the slides. And then distribution to retiring or deceased partners. We're not going to get into that, but I just want to provide just a general overview of that information if you're interested in knowing about that. So here's the general outline of the code sections that apply with respect to distributions. So Section 731 gives the gain or loss of distribution, and you're going to see that how it works. Section 732 gives the basis of any property received. 733 is the outside basis of the distributed partner if they continue. So if they don't have if they have a non-liquidating distribution. 734 and 735, these issues happen with respect to the 754 election with redistributions. And I know we talked about 754 and the effect of that election with respect to sales. We're not going to get into the specifics of that with respect to distributions. It's a little bit more convoluted beyond the scope of this discussion. And I have a slide that goes over it. You're welcome to take a look at that. So this is really distinguishing a liquidating from a non-liquidating distribution, also known as current or operating. So again, current distribution is a non-liquidating distribution, also known as, AKA operating. So you might see it called an operating distribution. The idea here is that after the distribution, the partner still has an interest. That's the key. So still has interest. Still has interest in the partnership. But a liquidating distribution is one in that it can be a series of distributions where the partner's interest is terminated in the partnership. So basically the partner no longer has an interest in the partnership. So we have some general rules for simple distributions. So remember, when you have distributions, we have simple versus complex. So we're talking about the general rules for simple, which are a lot easier than complex. Complex has special rules that we're going to have to go into. So with regard to simple distributions, whether it's a liquidating or a non-liquidating current operating distribution, we apply these rules as is. And I have special rules for distinguishing. You're going to see those later on. So first, there's no gain or loss to the partnership. Now, complex distributions, though, that's different. So with the simple distribution, no gain or loss to the partnership under section 731B. Gain only happens to the partner, to the distributed partner, the partner receiving the distribution, only if the cash exceeds the outside basis. So what I mean by cash is being paid. And this can be constructive cash later on as well. We're going to see as there's a discussion about liabilities, relief of liability. Cash or constructive cash. Constructive cash being relief of liability is greater than the adjusted basis. Then the excess is considered capital gain. Loss can only be recognized in a liquidating distribution when there's no tier 3 assets. And you're going to see the loss equals the outside basis minus the cash minus the basis of ordinary income assets, which will be tier 2 assets. You'll see that later on. And this loss, the loss will be capital loss. Will be capital loss. So here's the waterfall rules for simple distributions. Again, waterfall, which you've seen a lot with respect to the partnership rules, means that you just continue along until something happens. So first, the idea here is that a partner can be receiving multiple assets in a distribution. So the way that we know the partnership never has tax consequences, no gain or loss to the partnership. But with respect to the partner, by the way, I want to make a note of something before we continue. So the partnership never recognizes gain or loss. Contrast that with corporations, which the analogous rule, which is section 311, which says that when a corporation distributes property, the corporation must recognize gain but never loss. This is different for a partnership. No gain or loss will be recognized to the partnership. See that? That's huge. And that's a timing distinction. This is one advantage of a partnership LLC over a corporation, C or S corporation. All right? C or S corporation. Now, C or S corporation doesn't really pay tax, but so I mean, S corporation, that's fine. But if you're a C corporation, yes, that makes a difference. So that makes a timing distinction. I just want to bring that to your attention because in later videos, you'll see there's discussion about the different types of entities and the choice of entities and the benefits from tax perspective. So first we start with cash. Any cash distributed, that will first reduce the outside basis dollar for dollar. If the cash, and this, by the way, this cash means actual cash or constructive cash. So if a partner liquidates his or her partnership interest or reduces his or her partnership interest and the partnership has liabilities, the portion that the partner no longer owns, that's considered constructive cash because they're not responsible for that liability. The rest is capital gain beyond adjusted basis. Beyond adjusted basis. Next, we consider ordinary income assets. These ordinary income assets are assets that produce ordinary income, like accounts receivable, inventory. Those are some big examples. but there's others out there. You have to apply your general rules of tax versus capital versus ordinary property. Another example of something a little bit more nuanced would be a self-created copyright. Under Section 1221, remember that self-created copyrights to the party who is considered self-created are considered ordinary. So this we give this reduces the basis, and we give that full amount to the basis. So we carry out the inside basis, meaning that whatever basis that the item has in the partnership gets carried over to that actual item of the partnership, but it's limited to the overall outside basis. And this reduces the outside basis of the partner, which is his or her basis in the partnership interest, dollar for dollar. All right. Now, if there's not enough, you simply just stop. Okay. If there's not enough, you simply just stop with respect to that ordinary income assets. If there's too much, then that's when you get to take a loss. If it's a liquidating distribution. Tier 3, if there's other assets other than cash or ordinary income assets, if it's not liquidating, it's the same rule as Tier 2 above. But if it's liquidating, then the distributed assets take the outside basis. Now, why do we have a distinction? Because in a non-liquidating distribution, the partner still has a partnership interest. And we have to have a basis in that. So we have to figure out what is the adjusted basis of the partnership interest, and that's the last step. That is the last step. What is the basis of the partnership interest? If it's liquidating, you don't have that basis. So it just goes to those assets. And that's what it's saying here. It's distributed to the assets, you take the outside basis. Even if it's greater than the fair market value. If it's liquidating and there's no Tier 3 assets, the partner has capital loss. So what do I mean? If you're a liquidating distribution and you've gone through Tier 1, you've gone through Tier 2, you still have basis left, whatever's left is capital loss for the remaining amount. And those are the general rules. Now, I can only say general rules so much. It's important that you practice this looking at examples. That's the best way to understand it. And I'm telling you right now, once you go through it a few times, it's going to make sense. The rules, you'll see how they work out. These rules actually, they make sense. They're not, I mean, there's a little bit of abuse issues there with the ordinary items. Why? Because we don't want to give people ordinary losses to offset. So there's ways that, partnerships in the past were able to manipulate things. So that's why we have this system. It's this waterfall approach where the ordinary income assets, you don't get that ordinary loss, you get capital loss if it's beyond. Now, timing. The distributing property before cash can produce taxable gain when the opposite order does not. So the idea here is that if we go back, and the idea here is this is all a timing issue because we're doing it by tier, cash, ordinary income assets, other. If we did the other way, then it would not create it. Okay? If you distribute property, so if you do two separate distributions, and you do property, let's say 1 year and then cash the next year, this can create gain in 1 year, but not the other year. So it's important to keep that in mind. And again, Section 752B, deemed distributions of cash can trigger gain. So if going back to the previous slide, actual cash or constructive cash. So the Tier 1 cash includes actual or constructive cash, the constructive cash being relief of liability, which is a deemed distribution and can trigger gain. So here's a Section 734 inside basis adjustment. Again, this is when you have a 754 election in place and how it works. It's very similar to the sale or transfer of partnership interest, but it's a little bit more tricky because you have the integration of these rules. This is beyond the scope of this discussion. I just want to have this example for you. And here just is the effect, as well as from the McKee treatise. McKee is a very well-known treatise when it comes to partnership tax. It's the WG&L series of with respect to taxation, which is very, 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 if you're going to be a tax practitioner, you need to know that because when you have very difficult issues, WG&L is one of the first places to go. So you're welcome to look at that. All right, so now let's consider complex distributions. Complex distributions. So Section 751B deals with complex distributions. So how do you know whether somebody has a complex distribution? The idea is that 751B applies when a distribution increases or decreases the distributee's interest in unrealized receivables, which are defined in 751C, which I'll tell you right now are the same definition as the sale of a partnership interest discussion. However, the inventory rule has to be substantially appreciated, which is 120% of basis. The fair market value must be greater than 120% of the basis at the time it's distributed. This is a huge distinction from the sale rules. This is different because the sale rules were any inventory. Now it's just inventory that's considered substantially appreciated. The idea here is you can't get a loss. With the sale, you could get a loss. You could get that ordinary loss treatment. Here you can't. You can only get ordinary gain treatment with 120% or more. Now, what exactly do I mean it increases or decreases a distributee's interest? I'll show you on the next slide what I mean when I go through an example. So this one, we do need to look at examples you understand. So for 751B to apply, the distributee must receive a distribution of either 751B property or other property in exchange for relinquishing an interest in the type of property not received. So this can be a non-liquidating or liquidating distribution. So here's really the steps we go. Step 1, we recast the excess part of the distribution as imaginary distribution of the other classes, making this step proportional, taxed under the simple waterfall distribution rules as non-liquidating distribution. That's key, is that we look at it as a non-liquidating distribution. And then step 2, we do an imaginary taxable exchange to get from step 1 to proportional amount of the actual distribution. So let's look at an example. And I'll show you how you know that a complex distribution versus simple distribution. So ABC partnership has 3 partners. A, B, and C, they all own equally, 1/3. They all own 1/3. A is going to receive cash and complete redemption, meaning a full liquidation. So this is a liquidating distribution. So we know it's liquidating, but how do we know whether it's simple versus complex? Well, the way you know is you look at the assets of the partnership. We have cash, okay? We have inventory. You ask, are there any assets that are considered 751B assets, not 751C, 751B. So remember, unrealized receivables, and it has to, or 120% inventory. So we look at this inventory. Is it 120%? Yes, because we take 45 and we multiply that times 1.2. This equals 54. We then say, is 90, the fair market value, greater than 54? Yes. The 90 amount is greater than 54, so yes, this is substantially appreciated, so yes, it is a 751B asset. So this is a 751B asset. So whenever you have a distribution, the partner needs to make sure that he or she is receiving their fair share, their share of 751B assets. That's the key. That's how you know whether it's simple or complex. Is A receiving his or her share of 751B assets? No, because A is receiving cash but not receiving any inventory. So the idea here is that this ordinary gain, the 90 minus 45, which is 45, none of that is going to go to A. So A would have to get 1/3 of the inventory, of the 90, or $30 of inventory for this not to be a complex, for this to be a simple distribution. But guess what? A doesn't get any. So we use fair market value. So it's the ownership times the fair market value. So 1/3 ownership times the fair market value is 30. Is A getting 30? It has to be equal to 30. So if A got 60 of inventory, that's still considered complex. If A got 10, that's still considered complex. But here A is getting none because A gets all cash. So that's considered a complex distribution. So before the distribution, C had 1/3 interest in inventory. After C only has cash, therefore it's disproportionate. So again, the way we test it is right here. Okay? This is the only way it'd be simple, is that if the distributing partner A got exactly his or her share of the 751B assets. So 751B applies. It's not simple. So we go to our previous slide, we do our steps. We recast the excess part of the distribution as an imaginary distribution to other class. So what do I mean? Well, A is receiving cash, but A should be receiving also Inventory, that's the imaginary distribution. But in real life, A is not receiving inventory, he's receiving cash. Or I'm sorry, he or she's receiving cash. So we have to basically treat it like that. We make an imaginary distribution of the other classes first. So we do a non-liquidating first, and then we do the liquidating next to remedy for that. So what you see, step 1, we treat C as receiving a current distribution of $30 of inventory with a basis of $15 and $30 of cash. So what we're going to do is, there's 2 assets, right? There's 2 assets here. There's cash of 90, there's inventory of 90. So that means that C as a 1/3 partner should get 1/3 of the cash, 1/3 times 90, and 1/3 of the inventory, 1/3 times 90, 30 of each. So that's what we're doing. We're treating it as if C actually is getting that. So we analyze the simple distribution under our previous rules that we learned with respect to simple distributions. All right? So if we go back to our simple distribution rules right here, we apply these rules. Cash, that reduces the basis, then ordinary income assets, which is the inventory. Okay? So that's what we're doing. So what you see is that C has no gain or loss and takes an inventory of the basis of $15. Why? Because the $45 basis times 1/3 is 15, and under our rules, remember that this is non-liquidating distribution, so C is going to get that portion, and the rest is going to continue forward. So C has no gain or loss and takes inventory of a basis of $15. So C hypothetically now has $30 of cash and $30 of inventory. I know in real life you're like, what? Well, C got 60 of cash. That's how we do it for tax purposes. We're treating a hypothetical transaction. So this is what C has right here. C has this now after the transaction, again, hypothetical. You'll see why you need that next. And this is what the partnership looks like after. So these numbers are strike through. These are the new numbers. These are our new numbers. And C, you'll see later on, is going to be off the books there, right? We take C off. Even though we consider a non-liquidating distribution, C is taken off. See that? C is actually taken off there. So in step 2, C is going to exchange this imaginary hypothetical of $30 of inventory for $30 of cash. And we're going to look at the consequences to both sides. So in doing that, the basis, right, C is receiving 30 of cash, the amount realized is the 30 of cash minus the adjusted basis of the property given up, which is the inventory, which is 15. So C recognizes ordinary income of 15 because it's considered inventory. Ordinary gain or income of $15. That's where the ordinary income comes from. And the partnership is a $15 step up from in the inventory. So it goes up to 60. Goes up to 60. So it goes from 30 to 60. Why is that important? Because when A and B later sell, they're only going to have $15. And that's going to be in there. That's going to be in there. So this is what the partnership has after C is gone. Right? And this is what C has. C has cash. And C also recognized $15 of ordinary gain. Now notice if we applied the rules, the simple distribution rules, when C got cash of $60, right? It would all go tier 1 and C's basis of 45, right? So C would have $15 of gain, but it'd be capital gain. No. This is different. This is different treatment. It results in 15 of ordinary gain. So that's what the difference is. That's the difference. Instead of having 15 of capital under the general simple distribution rules, C has $15 of ordinary gain. Now it's possible also the partnership and the partners, A and B, also have to recognize gain or loss. Here they did not have to though. But it's very likely, and you'll see that in other examples, that actually happens. So there's various anti-abuse rules out there. These are just some of them. You can pause the video and take a look at these. They're beyond the scope of this discussion. Okay, payments and liquidation to retiring partner. I'm not going to go into the specifics of this. There's some slides here. The idea here is that Section 736 treats payments to departing partner that may not correspond to the value of the distributee's underlying partnership assets. It's really an ordering. You got to look at, so partner is retiring or leaving completely. And the idea here is that this is not the same as a distribution. What we do is we break it up into portions. So we divide payments into two categories. Section 736A payments are treated as guaranteed payments or distributive share, all payments that are not 736. So any payment that's not a Section 736, which is defined here, is treated as a guaranteed payment or distributive share, depending on the type. So these are generally payments not corresponding to retiring partner's share of underlying assets. 736B is the other type, and these are payments for the partner's share of underlying assets. These are taxed under the previously discussed Waterfall Rules for sales, distributions, and anti-abuse rules. So we apply the sale, distribution, and anti-abuse rules that we just learned for non-liquidating distributions or complex distributions, for simple or complex. Now there's special treatment for categorizing payments as unrealized receivables, goodwill, and payments in excess of the partner's share of partnership's assets known as premium payments. I'm not going to get into the specifics. The regulations detail those specific rules. So generally, here's the specific rules. You can look at these with respect to those items. Here's an example, which you're welcome to look at. Again, you have to break it up into 736A payments and 736B payments. So I have the steps. So I've created 5 steps for you to go through. So this is a good little checklist. So step 1, we determine the total amount that that's received. Step 2, we determine the 736B payment, because remember, 736A is all other payments. Step 3, we determine 736A payments, which is step 1 minus step 2. Step 4, we determine the portion of each year's payment with respect to each year, because you can have multiple payments over multiple years. And step 5, we look at the specific determination of each year's payment. So go ahead and take a look at this example I've gone through in the previous slide, and I've applied it to this example. So A is going to get A share of liabilities assumed by the partnership, right? So there's liabilities of $3,000, and each partner owns 1/3. So there's $1,000 at A, $9,000 in year 1, and $10,000 in year 2 and 3. And guess what? There's no express allocations of goodwill. So we have to address the different types of assets with respect to the different 736A and 736B. Now notice we have accounts receivable, so that's going to be unrealized receivable to worry about. So again, step 1, we determine the total received. A receives $30,000, $29,000 cash, right? The 9 plus the 10, right? And the $1,000 of the liabilities as well. So that's $30,000. The $10,000 amount came in from the initial payment. That's where that came from. So we determined the Section 736B payment, which is the $13,000 of cash plus the $23,000 of capital, which times 1/3, which gives us $12,000. $12,000. Also in there is the $1,000 of liability discharge. I forgot to put that in. Oh, I'm sorry, that's in there. That's in the $13,000 of cash. Step 3, we determine the 736A payments. Step 1 minus step 2, so $30,000 minus 12 gives us $18,000. Step 4, we determine the portion of each year's payment. So what we do is in year 1, we have $10,000. In year 2, we get $9,000 and also the $1,000 of liability relief. And then also another $10,000, right? That's, by the way, where the other $10,000 came in, the $29,000 cash. So you have that amount. So you have to multiply those amounts for each year. Is really, you get the pro rata percentage and you multiply. So each year you have $6,000 of guaranteed payment and $4,000 of 736B payment. So you have 3 years, year 1, year 2, and year 3 is the idea. So each year you have $6,000, $4,000, $6,000, $4,000, $6,000, $4,000. And then any specific determination in years, year 1 and 2, we have $6,000 of ordinary income because of guaranteed payment. In year 3, we have $6,000 ordinary plus $1,000 of capital gain because the outside basis was $11,000 and now it's been exceeded. So we apply our normal distribution rules, right, or sales rules, same idea. And now the adjusted basis has been recouped, so everything beyond that is now capital gain. And that's the idea. And that's really how you do 736 with respect to a retiring partner. It really combines all the sales and distribution rules together. Incorporation of Partnership, this is the different methods. There's a revenue ruling out there, 84-11, that deals with, there's 3 methods that a partnership can go from, or any entity that's treated as a partnership can go from a partnership for tax purposes to a corporation for tax purposes. There's also some other methods out there with respect to LLCs, and that's the check the box, and then LLC merges into a wholly owned subsidiary of a corporation. So just look at that generally. So that really concludes the discussion on distributions and retirement of a partner.